The morning everything changed. Picture a cold December morning in Buenos Aires. The year is 2001. A schoolteacher named Maria has just turned 44. She has spent 22 years in the classroom. She owns a modest apartment, 2 bedrooms, a small kitchen, a balcony overlooking a courtyard of orange trees. Her life is not extravagant, but it is built. It is hers. She has $17,000 in her bank account, not pesos, dollars. She made that choice deliberately. She had watched the peso lose ground before. She'd seen what slow currency erosion does to ordinary savings. So she converted everything into the most trusted currency on earth. She believed she had built a wall around everything she had worked for. She woke up that morning, made her coffee, and turned on the radio. She heard a word she had never heard used quite like this before. Corralito. In Spanish, it means little fence. Within the hour, she understood exactly what that fence was for. It was not there to protect her savings. It was there to trap them inside. It is not a story about politics or bad luck or a single government's failures. It is a pattern that has appeared in at least 6 countries across more than a century of documented economic history. It has destroyed the savings of millions of careful, responsible, hard-working people who did everything they were told to do. People who saved. And it wiped them out anyway. Not because they were reckless, but because they were entirely inside a system that failed around them. This video is about 5 specific types of assets that the historical record has shown, again and again, to be among the most dangerous things you can hold when a currency goes through a severe debasement. Not the volatile assets, not the speculative ones. The dangerous ones are the ones that look completely safe, right up until the moment they are not. Context: how currency crises actually work. Most people picture a currency collapse as a sudden explosion. One day, everything is normal. The next day, it is gone. But that is almost never how it actually happens. A currency crisis is not an explosion. It is a slow flood. The water rises so gradually that people keep adjusting, keep moving to higher ground in small steps, without ever realizing how far they've drifted from where they started. Then one day they look down, and the floor is completely gone. The mechanism behind every major currency crisis in recorded history follows the same basic sequence. A government spends more than it collects. To cover the gap, it borrows. When borrowing becomes too expensive or eventually impossible, it does the next available thing. It creates more money. This process is called monetary debasement, reducing the real value of a currency by expanding its supply faster than the underlying economy actually grows. If there are 10 apples in a room and $10 in circulation, each apple is worth roughly $1. If you print 10 more dollars but the number of apples stays the same, each apple now costs $2. The apple did not change. Nothing about the apple changed at all. The money simply became weaker. That is debasement. And it has been the quiet engine running in the background of every major currency crisis in modern history, invisible to ordinary people, accumulating pressure until the day the dam breaks. The United States dollar has lost between 85 and 98% of its purchasing power since August 1971. The date President Nixon closed the gold window and severed the dollar's last connection to a physical anchor. Before that date, the dollar was backed by something real. After that date, every major currency on earth became, in essence, a promise backed only by the faith in the institution making it. Since then, every dollar held in savings, every bond, every fixed income product has been quietly, continuously eroded, not destroyed, eroded, the way water wears down stone, slowly, steadily, almost imperceptibly. The question this video is asking is, What happens when that erosion stops being slow? What happens when it accelerates? History has a very clear answer to that question, and it is the same answer every single time. Asset 1. Long-term government bonds, a cage made of paper. The first asset on this list is one that governments, financial advisors, and institutions across the world have promoted as the gold standard of safety for more than a century: long-term government bonds. These are the loans you extend to your own government in exchange for a fixed payment over a fixed number of years. In the United States, they are called treasury bonds. In Argentina in 2001, they were called bonos. In Germany in the early 1920s, there were government war bonds, purchased patriotically by millions of ordinary German citizens to support their country during the First World War. Those German bonds were considered the single safest investment available. They were backed by the full weight of the German government, and by November 1923, they were worth nothing. Not reduced, not devalued. Mathematically, practically, completely nothing. Before the First World War, the German mark was a respected international currency, roughly for marks to $1. By late 1922, $1 bought approximately 9,000 marks. That already sounds catastrophic, but it was only the beginning. By May 1923, $1 bought 40,000 marks, and then the acceleration turned vertical. By November of that year, $1 was worth over 4 trillion marks. A loaf of bread in Berlin cost 200 billion marks. Workers were paid twice each day so their families could rush out and spend the wages before another hour of inflation eroded the value further. People physically wheeled cash to market in the German middle-class teachers, doctors, civil servants, small business owners, was functionally destroyed. The war bonds they held paid back their face value in marks, exactly as promised. But 4 trillion marks was worth less than a single American cent. The contract was honored perfectly. The value was gone entirely. This is the core trap embedded in every long-term government bond. It is hidden inside ordinary financial language, which is why most people never see it. A bond is a promise written in the currency. If the currency weakens, the promise weakens with it. You are not being cheated. You are being paid exactly what was agreed. But what was agreed upon is no longer worth what it was worth when you made the agreement. A long-term government bond is a cage made entirely of paper. When the currency inside the cage catches fire, the cage burns along with it. Asset 2. Cash savings, the bedrock that dissolves. The second asset will surprise more people than anything else in this video, because it is the asset that every financial institution in the world instructs ordinary people to build and protect. It is what your parents told you to accumulate. It is the foundation most people believe their financial security rests upon. It is cash savings, savings accounts, certificates of deposit, money market funds, the interest-bearing products that sit inside banks and grow quietly over years and decades. Not investments, not bets, savings, careful, responsible, dutiful savings. In November 2008, at the peak of Zimbabwe's hyperinflation, the Reserve Bank of Zimbabwe issued a banknote with a printed face value of $100 trillion. That note, when it was physically distributed, could barely purchase a single loaf of bread. Economists estimate that Zimbabwe's inflation reached a rate of approximately 89.6 trillion% in that month alone. The number is so large it loses all meaning. But here is the detail that every serious analyst of this period emphasizes. It was not the reckless who suffered most. It was the cautious. It was the nurse who spent her career saving in Zimbabwean dollars. It was the school teacher who never gambled, never speculated, never did anything except exactly what she was told to do. These people were systematically destroyed precisely because they had placed complete trust in a system that was hollowing itself from the inside. The same pattern appeared in Venezuela between 2016 and 2019. Ordinary families drained their savings accounts, not for vacations or luxuries, but to stockpile enough basic food to survive the coming months. By early 2018, the Venezuelan government officially devalued its currency by over 99%. They stripped 5 zeros from the bolivar, renamed it the sovereign bolivar, and declared a fresh start. By 2019, even that new currency was being abandoned in favor of US dollars for everyday commerce. The total devaluation of the Venezuelan bolivar across the full arc of the crisis reached a figure that reads like a typo. 8% of its nation of US dollars for everyday commerce. The total devaluation of the SCL for the total devaluation of the Venezuelan bolivar across the full arc of the crisis reached a figure of USC, which they specced out. Cash savings in bolivars were not merely diminished, they were erased. Savings accounts are, at their core, a promise of future purchasing power. When a currency is being continuously debased, that promise is being broken a little more every single day. Not visibly, nor with any public announcement. Quietly, the way a hidden leak works through the foundation of a house, invisible on the surface, until the day the structure gives way. Asset 3. Fixed pensions and annuities, the promise that starves you. The third asset generates the most resistance when it is raised in this context. It is not dramatic. It is not associated in any public way with financial risk. Most conventional financial planners describe it as the responsible, mature, sensible choice for long-term retirement security. The asset is fixed annuities and nominal currency pension payments, arrangements where you contribute money over your working life, or pay a lump sum up front in exchange for a guaranteed fixed monthly income for the rest of your life. On paper, these are the definition of stability. In practice, during any serious episode of monetary debasement, they've become a slow financial sentence that the recipient cannot escape. Consider what happened to German retirees during the hyperinflation of 1923. A retired postal worker who had contributed to his pension for 30 years with perfect discipline continued to receive his fixed monthly payment throughout the entire crisis. Not a single payment was missed. The government honored every pension obligation completely and on time, but a payment that was entirely sufficient to live on in 1920 could not buy a single egg by late 1923. Not a week of groceries, not a day of groceries. 1 egg. The pensioner received his payment. The government kept its promise to the letter, but the promise had become entirely divorced from any real economic value. It was a fixed number in a currency where numbers had lost their connection to reality. The promise was kept. The pensioner starved on it. Most people will never understand why until they see it happen, because the mechanism is invisible right up until the moment it is not. As said 4. Large bank deposits when savers become the rescue fund. The fourth asset requires careful attention because it involves a legal mechanism that most people in stable, wealthy countries are completely unprepared for, and most refuse to believe is possible until it happens to someone they know personally. The asset is large bank deposits. Specifically, deposits that exceed the legal insurance threshold. In the United States, the FDIC insures deposits up to $250,000 per depositor per institution. Above that threshold, you are not a protected depositor in any meaningful legal sense. You are an unsecured creditor of the bank. You're at the back of the line if the institution experiences severe financial distress. On the morning of March 25, 2013, the citizens of Cyprus woke up to discover that their government had finalized a bailout agreement with the European Union and the UNV's International Monetary Fund to fund the $13 billion rescue package. The terms included something that had never been done in modern European financial history. Depositors were required to pay, not shareholders, not bondholders, not hedge funds, depositors, ordinary people who had placed their money in banks for safekeeping. At the country's second largest bank, every deposit above €100,000 was fully and permanently confiscated, not temporarily frozen, not reduced, gone. At the largest bank, 47.5% of all deposits above €100,000 were seized and converted into bank equity. The European Court of Justice later dismissed all compensation claims and ruled the seizures fully legal under the terms of the agreement. Lebanon followed with a slower but in many ways more total destruction of deposits beginning in late 2019. Banks first imposed informal weekly withdrawal limits. Then those informal limits became formal policy. Then they became absolute. By the time the crisis fully developed, the Lebanese lira had lost more than 95% of its value against the US dollar. Depositors who held dollar-denominated accounts, people who believed they had protected themselves by saving in foreign currency, found that those dollar accounts could only be accessed in lira at official government exchange rates bearing almost no relationship to the actual market rate. They had real numbers on real statements. Those numbers became vapor. Total depositor losses have been estimated at $51 billion in real terms. 3/4 of the Lebanese population fell below the poverty line. The pattern is consistent. Every time a currency system reaches the point where the gap between what has been promised and what can actually be delivered becomes too large to conceal, the system begins searching for where the accessible money is, and where the accessible money is sitting in banks, in bonds, in fixed contracts, is exactly where the losses are eventually allocated. The people who held those assets did nothing wrong. They saved, they planned, they trusted. They became the solution to a problem they did not create and did not see coming. Asset 5. Total system concentration. The real hidden danger. The fifth entry on this list is less a specific product and more a structural condition. It is the condition of being entirely embedded in the paper promise ecosystem of a single, devaluing currency with no counterbalance anywhere in your financial life that exists outside that system. No physical asset, no geographic diversification, no inflation-adjusted income, no hard asset of any kind. Paper promises denominated in the currency, held inside institutions that are part of the same system as the currency itself. The historical record is not a condemnation of any single investment vehicle in isolation. What it consistently identifies as the most dangerous position is concentrated exposure to a single currency's paper promise ecosystem with no bridge to anything that holds value independently of that system. Think of it this way. Imagine you own a jar of deeply colored water that is being diluted with plain water every single day. Someone agrees to buy future jars of your colored water at a fixed price for the next 20 years. 5 years from now, when your water is barely tinted, they still pay the price they originally agreed to. That price once represented real, concentrated color. Now, it represents almost nothing in real terms. The contract was honored exactly. The value was not. That is the nature of every nominal currency contract during monetary debasement. Different countries, Different decades, different political systems, the same result, the pattern, what those who survived had in common. The historical record across Germany in 1923, Argentina 2001, Zimbabwe 2008, Cyprus 2013, and Lebanon 2019 reveals three broad characteristics consistently shared by those who preserved meaningful wealth through each reset. This is pattern recognition, not financial advice. Every individual situation is different, and qualified professional guidance is essential before making any financial decision. The first characteristic, possession of assets with real-world intrinsic value that existed independently of any currency promise, physical property, agricultural land, productive businesses that created tangible goods. These things held their worth, even as the currencies around them collapsed, because their value was not written in the failing currency. A farm in Weimar, Germany, in 1923, did not lose its real value when Marx collapsed, because its real value had never been expressed in marks. Its value was in wheat, eggs, and firewood. The farmer who owned land outright, without large debts in the inflating currency, emerged from 1923 in a stronger relative position than nearly everyone around them. The schoolteacher with a savings account full of marks did not. The second characteristic, diversification across systems, not merely within a single system. In Cyprus, those who lost the least held assets in banking systems outside Cyprus, in jurisdictions with different legal exposure to the local crisis. In Argentina in 2001, the deposit freeze applied to accounts within Argentine banks. It could not legally reach assets held in Uruguay, Switzerland, or the United States. Those who had distributed their financial lives across different legal frameworks, different countries, different institutional structures, retained access to at least a portion of their wealth. Those concentrated entirely within the Argentine system lost access to everything above the withdrawal limits. The third characteristic is the most counterintuitive finding in the entire historical record on this subject, and the one that generates the most disbelief when first encountered. Many of those who came through these resets in the strongest relative position held moderate debt denominated in the devaluing currency at the time of the collapse. This sounds precisely backwards, but consider what happened to Argentine homeowners who carried peso-denominated mortgages when the peso lost two-thirds of its value in 2002. Their physical property remained. The real burden of the mortgage shrank dramatically because the debt was denominated in the currency that was collapsing. The same phenomenon was documented at scale in Weimar, Germany. Landowners and business owners with reasonable amounts of mark-denominated debt emerged from the hyperinflation with physical assets intact and debts reduced to trivial sums by the currency collapse itself. Return to neighbors. Two different outcomes. Return now to Maria, our schoolteacher in Buenos Aires. December 2001. After the government announced the deposit freeze and formally broke the currency peg in January 2002, her $17,000 account was forcibly converted to pesos at a government-mandated rate. The peso was then released into open markets to find its real level. The market had a very clear view of what it was worth. By spring 2002, the peso had lost more than 66% of its value against the dollar. Maria's $17,000 had become, through forced conversion and devaluation, the purchasing power equivalent of roughly $6,000. She received every peso she was legally owed. The government honored the technical terms of every obligation, but the obligation had been rewritten in a currency that had been made smaller, while she was legally prevented from moving her money out of the system. She did everything right. She lost everything anyway. Her neighbor, Roberto, had made different decisions 12 months earlier. Unsettled by the trajectory of Argentine government debt, he converted a meaningful portion of his savings into a small rental department in early 2001. He kept some physical dollar cash in a personal safe, not a bank account, because a bank account would be subject to any freeze. When the Corralito arrived, his rental property kept generating income. His physical cash was not covered by the freeze because it was not a deposit. He lost some wealth in the chaos of those months. He did not lose everything. He came through the other side, bruised but standing. Maria spent the following years rebuilding slowly. She was not alone. Most Argentines rebuilt over time, and the country eventually recovered. But the specific savings she had accumulated across 22 years of dedicated work, the careful savings she had believed were fully protected, were gone. Not because she was reckless, not because she had made bad bets, because she was entirely and exclusively inside the paper promise system when the paper was reset. Closing the record, not the prediction. This is not a video about Argentina. It is not about any single country, any single government, or any single crisis. It is about the pattern that 6 different countries across more than a century of documented history have demonstrated, consistently, without exception, and about the structural question of whether the conditions that historically precede this pattern bear any resemblance to conditions visible in the world today. That is a question each person watching must examine carefully, honestly, and with professional guidance appropriate to their own specific situation. What history offers is not a prediction. It is not a prescription. It is a record, unfiltered, exactly as it happened. And the record is more instructive than any forecast could ever be. Most people will watch something like this and return to feeling comfortable, but is entirely human and entirely understandable. The discomfort of examining the systems you participate in every day is real. Most people are not in the habit of looking too closely at the foundations beneath their financial lives because the foundations usually hold and because the systems themselves quietly discourage deep examination. But if one person in your life is sitting on a concentrated position in paper promises, inside a single system without understanding what a century of economic history has to say about that position, consider sharing this with them. Not because it changes the world, because it might change their world. Nothing in this video constitutes financial advice. The events described occurred under specific historical conditions that may or may not resemble conditions elsewhere or at other times. Past patterns do not guarantee future outcomes. Please consult a qualified financial professional before making any financial decision.